Good afternoon, everybody, and thank you for assisting to this webinar presented by SSQ Insurance. My name is Matthew Roy, Investment Fund Analyst at SSQ. We're pleased to welcome today David Onyett-Jeffries, Vice President, Multi-Asset Class Solutions at Guardian Capital. He's here to talk to us about their managed solutions, which we have on our investment platform through the Guardian Monthly Income and Conservative Monthly Income Strategies. David will also take the time to give us their market outlooks for the near future. Please note that if there is enough time at the end, it'll be our pleasure to answer one or two questions that you can ask via the WebEx interface. You can also communicate with your SSQ Insurance representative for all other questions. So without further ado, David, the floor is yours.
Good morning, and thank you for having me. I just want to make sure everybody can hear me. Are we good on the line?
Yes.
Yeah. Okay, excellent. So end of the year, it's a good time to sort of reflect on what we've had happen this year and what it can mean for the year going forward. So if we can go to the next slide and the next one as well. So for all intents and purposes, if you're an investor in basically any asset class this year, it's been a good year. So this data is as of November 15th, but more up to date. You know, we're seeing major equity sectors, Canadian U.S. equity total return in excess of 20%, even 15% in EFI, which is Europe, Australasia, and the Far East. And even bond investors are looking at something between, 5 and 10%. So as mentioned on the platform, I'm going to focus more on a macro backdrop and discussion, but we are using the macro views as an overlay for our strategies, which are tactical multi-asset. Even looking at our conservative monthly income fund, it's a 40% equity, 60% bond fund, and it's still up in excess of 10% this year. It's all in been a pretty good year for investors. However, if we go to the next slide, it hasn't been a one-way street, all right? If we look back to a year ago at this point in time, we're in the midst of a very, very sharp market sell-off, and we had an aggressive rebound to start this year, through January and February, but since then it's been a lot of bouncing around, ups and downs. So the gold line there is looking at the S&P TSX, the Canadian stock market, and the dark line is Canadian bond yields. And there hasn't been sort of a one-way direction. There's a lot of volatility at play. Which makes, for investors, well, it's good that we've had these positive returns. It hasn't exactly been a very calm and steady year. There's been a lot of fluctuations. And if we go to the next slide, what we're seeing is this resumption of market volatility. So this chart is the CBOE U.S. Equity Market Volatility Index. It's commonly referred to in financial media as the VIX. And it's a gauge of equity market movements. And what we saw after 2017 was a year of abnormal calm in the marketplace, and I've highlighted some key risk events. What we've seen throughout last year and again this year is just sharp movements in the market. We've had a couple of sharp equity market corrections. We've seen big drawdowns and rebounds and a lot of bouncing around. And this is the kind of thing that makes investors uncomfortable. This is a roller coaster ride of financial markets. But the important thing when we're looking at the market outlook and the macro backdrop is to see what's the source of volatility, right? If it's something that is sort of a spurious event or a one-off event, it's not to be as concerned about, because historically, people get concerned when you see more volatility, but it doesn't necessarily mean that there's a gauge of sort of a downturn, an overall sustained downturn in the market or a recession for the global economy. There's an economist in the 1960s by the name of Paul Samuelson who made the comment that the equity market does not have a particularly good track record of calling recessions. It's called 9 of the last 5 of them. And what we're seeing is this pickup in volatility. It's being driven by, if we go to the next slide, it's a shift in sentiment, right? So this is not underlying factors. It is a swinging in terms of people's views on the outlook. So this chart looks at the ratio. So it tries to do an overall gauge. It looks at bullish investors, so investors who are expecting equity markets to rise over a 3-month period versus the people who expect them to decline. So this is the bearish investors. And what we can see is, at the beginning of 2018, there was some excessive optimism in the marketplace. And throughout the year, everything sort of cratered, and we had that sharp recession at the end of last year, which put everything in the excessive pessimism. And what we've seen so far this year is a lot of bouncing around. It's towards the upper end of the optimism, which makes sense when you've had markets that are rising in excess of 20%. But at the same point, it's been volatile. And as a result of this sort of movement in market sentiment, investor opinions, it's been what caused the market fluctuation. And the important thing that I want to emphasize is if we go to the next slide is, while we have movement in the marketplace and sentiment can shift on a day-to-day basis, the underlying fundamentals of a company, of a stock, sorry, my apologies. The actual fluctuations in the marketplace, when you look at that, you'll have more movements in the price than the underlying fundamentals of a company and the economy in which it operates. And this chart is something I'd like to highlight. So this looks at forecasts. So consensus forecasts, they go and collect economy watchers globally and ask them what they expect growth to look like for the years 2019 and 2020. And this is looking at the evolution of these forecasts. And what we saw at the beginning of 2017, we were at about 3.2% for global growth in 2019. And that was a time when markets were going very, very well. There was extremely calm in the marketplace. There was limited volatility, and markets gradually just rose very high. And then as we moved into 2018, there was this expectation that we're going to have this synchronous growth, and everything was going to be very strong. And we saw expectations start to rise a little bit. And then when we had momentum start to slow and these high expectations not necessarily be met, we had expectations and forecasts come down, and this goes for 2019, so the current year about to end in about 3 weeks, and for 2020. But what I want to highlight is where we are right now is expectations are for growth to be around 3.2%, which is exactly where we were 2 years ago, right? And times have not exactly been poor, because ultimately these fundamentals have been holding, and this is a positive development, right? You have the fluctuations from sentiment, but underlying fundamentals are okay. And if we go to the next slide, the expectation is that we're going to see a lot of more of the same. And that's not inherently a bad thing, because as any investor who's been involved in the market over the last decade, performance has been good. Now, there's concern about the strength of this overall economic expansion, but it hasn't been terrible by any means. And we've seen this sort of sustained growth. Now, there's no expectation that we're going to see some sort of sudden reacceleration, because we're seeing demographic issues, like structural issues in major developed economies, and a large one is demographics, where you have a large, the baby boom generation retiring and falling out of the labor force, and labor is a very important component to economic growth, and so you can't create, you need inputs to production to create output, and if you see those inputs starting to slow and labor is a key input, then you're going to see everything else sort of flowing with it. But the expectation is we're going to continue to see this sort of slow and steady growth. And that's not a inherently bad thing for markets. Like if we go to the next slide, there was a lot of concern this year. So this is the OECD Leading Economic Indicator. It's a gauge of economic momentum. So the level of the chart is sort of, it's viewed as a second derivative. It's the speed. And what we saw in 2018, there was this big pickup in the speed. And then through this year, we saw sort of a relatively modest deceleration. But it was a deceleration and broad-based. And this is when people started getting more and more concerned that we were verging towards recession. And again, a recession is a bad thing for markets because it means that overall growth is slowing, that profit growth is slowing, and the fundamentals have weakened. But what we have seen play out this year, and especially in recent months, is that we're going back towards the zero trend line. What that means is that we're not seeing a deceleration, we're seeing a stabilization. Growth is just sort of stable. And that, again, is inherently a positive thing. We're not continuing. If you look at this chart and look at previous periods of recession, which are the gray shaded areas, the big concern is when you had this continued deceleration. But we didn't see it. We've seen the stabilization. And in particular, if we go to the next slide, one area that was flagged as a big area of concern was the manufacturing area, manufacturing and factories in the world. Because we saw this, again, sharp deceleration. This chart is a Manufacturing Purchasing Managers Index. It's referred to as a PMI. And again, it's a sentiment gauge of economic momentum, specifically in the manufacturing sector. And you can see, again, if you look at 2017, you had this increase. So that means the expectation was that growth was going to accelerate. And then through last year and through most of this year, you had a deceleration. And what was really flagged is over the summer, you had this measure, and again, looking at the world, the G7 and the BRICS, so those are major emerging market economies for the BRICS, and the G7 are the 7 major industrial economies. It dipped below that 50 threshold, which meant that growth was actually contracting. And when people were seeing this as a leading, this measure starting to contract, that was sort of people raising concern about an impending recession. But the important thing to realize is that while this indicator has a very long track record, and one of the reasons why it gets a lot of attention is because it has been a long-term gauge. So for the U.S., for instance, this gauge has been around since 1947 and has a good track record of calling economic slowdowns. But manufacturing isn't as important as it was. And this is something that needs to be taken into consideration. So if we go to the next slide, just to put it in context, any sort of slowing in an area of the economy is obviously not a positive thing, but the manufacturing sector globally in 2018 versus what it was in 2008, and even if we go back further, it's not as important as it was. So this chart looks at manufacturing share of GDP by country, and the shaded line in the middle there is the world, and it shows that in the last decade we've had a decrease in importance of manufacturing. And it isn't just the advanced economies. And if you look at this chart, virtually all countries that we're covering here, so this is like 36 major economies that we're looking at, outside of Ireland, there's been no real region that's had a pickup in manufacturing. It's actually becoming less important. That's not to say it's not important, it's just not as important as it was. And therefore, if you're looking at a gauge of economic momentum, 15% of the economy isn't nothing, but what's more important is that other 85%. So if we go to the next slide, what we're seeing is globally a big factor of the economy that drives the global economy, and especially developed markets, is the consumer. And when it comes to consumers, what matters most to them is their ability to sort of meet their daily lives. Right? Are they going to have enough money to cover rent? Are they going to be able to put food on the table? Can they take a vacation if they want? And what drives that is their job status. And what we're seeing globally right now, even with weakness in manufacturing, which has had a sizable impact on areas such as Japan and Germany, unemployment rates globally are low. And I'm not just talking about cycle lows, which, again, for the large swath of economies, that is the case. But for other economies, so if we're looking at Canada, the US, Germany, Japan, we're talking generational or all-time lows. And this is even with this sign of weakness in the manufacturing sector. Because again, manufacturing isn't everything. The other 85% of the economy matters. And what this is telling us right now is, if you are an economy that is dependent on the consumer, which again, Canada is, the US is, most major economies in the world, because if you look at global GDP, about 2/3 of it is the consumer. If you have low unemployment rates, it means that people aren't too concerned about their jobs and losing their jobs. They have that job security, they're more willing to spend. And if you have people who are willing to spend and consume, it's going to drive economic growth. This is the key fundamental cog that people need to pay attention to. And it's one reason why you haven't seen much of a shift in overall economic forecasts, is because the consumer is still healthy. And if we go to the next slide, it's not even just that the unemployment rates are low, it's that wage inflation is actually picking up. So people are working more and getting paid more to do so. What that means is incomes are rising in aggregate and per household, if you want to look at it on that basis. So this chart looks at the G7 wage inflation, so G7, 7 major industrial economies. So like looking at things in aggregate just to get an idea of overall strength, because you can have, it isn't just one area, it's fairly broad-based that we're seeing this pickup. But what happens if you have more people working and getting paid more to do it? It reflects on this next chart. So this is real retail sales volumes growth year over year for the OECD. So 33 major global economies, or 36 major global economies that comprise the OECD. And what this is showing is, there's been no real variation in underlying growth in retail sales. So this consumer spending, and looking at on a volumes basis, so it's ignoring prices. And what we've seen is the real retail spending has held around that 2%. So we haven't really seen a material slowing in this area at all, which again is something that's typically consistent with recessionary conditions or economic slowdowns. We still have a strong consumer, which means that there is reason to expect that an economy in motion, which we have seen in place, is going to continue. What matters, though, is there something that can derail the economy at this point? There's something that can weigh on consumers, that can create sort of job losses that will then, inhibit consumer spending, which will then have these negative impacts across other areas of the economy. And really what is happening right now is if we go to the next slide, there is a growing amount of uncertainty in the marketplace. Right? It hasn't really translated too much into job loss anywhere, but this chart is a global economic policy uncertainty index. It is some academics have tried to quantify an intangible idea of uncertainty. And one thing that we have found, or that the data has shown, is there is this massive uptick in uncertainty. And from a market perspective, this goes hand in hand with the increased volatility and the swings in investor sentiment. Because as investors, the one thing that you hate more than anything is uncertainty. You want to know for sure that your company is going to generate earnings, going to be able to pay out dividends. If you're a bondholder, you want to know for certain that you're going to get your regular interest payments and eventually the principal payment on the bond. If you throw some uncertainty in the mix, it can create, a less positive macro environment. But so the question is, what's driving this uncertainty? Is this something that we need to be concerned about, having massive spillover effects? And if we go to the next slide, it's kind of interesting with this data set. You're able to actually drill down into the specific causes of uncertainty. And this is looking specifically at the U.S. and highlighting, areas. So if we look at 2012, 2013, there was all this concern about the U.S. defaulting on its debt, and that's when you saw that black line ticking up higher. But what we're seeing right now, and based on this measure going back to 1997, we're at unprecedented levels of uncertainty related to specifically trade policy. Now, this shouldn't come as any surprise to anybody who's paid attention to the news with everything related to the trade war, the trade conflict, the issues related to China and the U.S. This is just emphasizing and highlighting that we're able to break it out. What are the biggest risks to the outlook going forward? Because again, an economy in motion should continue. There's that inertia with everything, but what are the risks that can actually cause things to be derailed? And this concern about trade policy matters. And the reason it matters, if we go to the next slide, is that over the last 20 years, there has been a concerted effort to increase trade flows. There's been an opening of trade. So China joined the World Trade Organization, which meant that they could be a larger participant on the global stage in 2001. And that coincided with that the growth in world trade flows. If you look at the gold line in the aftermath of the tech bubble bursting in 2000, you see sort of a sharp acceleration there. And a large part of that is China becoming more ingrained in the global trade processes. And also, freeing up trade has led to a more integrated global economy. And so it's not coincidental that we have trade and GDP growth, so overall economic growth for the G20, so 20 major global economies, going hand in hand. But the concern is now that we have these barriers to trade going up, so it's the opposite of what we've seen for really about a century of efforts to free trade, lower tariffs, reduce quotas, import quotas, and things along those lines. We started to see trade barriers start going up again. And this, again, is this trade policy uncertainty, because you're having a situation in the U.S. where the leadership on a daily basis, regardless of what your politics are, they're sowing uncertainty, and specifically as it relates to trade, which is increasingly important. And what we've seen is that trade flows have more or less, trade flow growth has collapsed this year. And through a large portion of it's related to sort of the trade uncertainty. And the big concern is growth going to be able to continue to be sustained? So far it's managed to weather the storm, and a lot of that is tied to the strong consumer, but are there going to be negative spillovers as a result of this? So if we go to the next slide, I made a point earlier about manufacturing sort of having a diminished importance, but trade is actually having a growing importance in terms of the global economic machine. So this chart looks at imports and exports, so just an idea of overall trade as a share of GDP. And what we can see is that, the main combatants in this trade war right now are the U.S. and China. And they're at the far right end of the screen, meaning that trade isn't exactly the most important thing to their domestic economies. But because of how trade works, and there's a lot of sort of moving parts, and goods go across one border and across another. So, like as an example for Canada, I've seen some estimates that say when in the course of building an automobile, an auto part will ship between Canada and the U.S. It will cross the border 7 times. And you throw Mexico in there as well. I think it's the number goes out. It will cross a border. It's like 10 times in the course of production. So if you have barriers going up with the U.S., it doesn't just, while that may not have a huge impact domestically on the U.S. because trade isn't the most important thing in their economy, it has negative spillovers in other places because of the interconnectedness of the global supply chain. And again, this is a development over the last 20 years. And as with, when you're looking at a stock market, you're seeing a stock market rally, a stronger rally is one that has many, many companies participating in the upswing. That same can be said for economic expansions. It's not just one country leading the way. It's not just the U.S. or not just China and everybody else is sort of stagnating behind them. The more economies, the better the breadth of growth, the stronger it's going to be. Now, the concern with this trade war, and the longer it goes on, and the higher the tariffs go and the more barriers that go in place, and right now it's more or less localized between the U.S. and China, but there's been threats on expanding Europe into that coverage. Tariffs on steel and aluminum produced in Brazil and Argentina have been increased as well. The more that are impacted, the bigger the impact is going to be, especially if you look at a lot of countries in Europe and in Southeast Asia, they're more reliant on trade, and particularly they're reliant on trade with the U.S. and China. So this is an area of concern because if you start seeing these dominoes start to fall, then it's going to rise more concern about the overall economic health. Now if we go to the next slide. But the important thing too is if you look at the U.S., putting up these trade barriers is actually bad policy on a domestic front as well. The whole idea behind trade barriers, and despite what some politicians may be assuming, is that it's not the exporter that's paying the tariffs, right? It is actually the importer. So China sends goods to the U.S. They're not paying any taxes. They're not putting any money into the U.S. Treasury. It is domestic consumers and domestic businesses in the U.S. So this chart looks at the average government customs duties revenue. So it's money coming in from tariffs. And basically from 1990 to roughly 2016, there's minimal variation in terms of the monthly flows. And at this time, trade has accelerated greatly. So if you actually look at the dollar value as a percentage of traded goods, it's diminished. But in 2018, with the onset of the trade war as it is, with tariffs being introduced, we've seen this amount spike. And now, why this matters, because it carries over negative domestic implications. Suddenly, goods that are imported, and a lot of goods aren't easily substituted away, so you can't just suddenly, if you are a domestic, if you are a U.S.-based company the U.S.-based company that is dependent on goods that are produced in China as an input to your production, you can't suddenly source either in the magnitude or the quality or the cheapness from somewhere else, and especially not very quickly, right? So this creates sort of inflationary pressures and negatives domestically in that suddenly things are more costly, or margins have to go down, or prices have to rise, which negatively impact U.S. companies. And this is what we're seeing in terms of the tariff revenue starting to rise. The other aspect of it, if we go to the next slide, is that these trade actions, these tariffs that the U.S. is putting up, aren't being done in isolation, right? There's retribution that's being done. And while trade may not be the biggest part of the U.S. economy, it's still important to some areas, in particular, especially in the manufacturing sector and industrial areas. And what we've seen is that in retribution to retaliation for the trade actions done by the U.S. on China, China's retaliating as well. And what we've seen over the past, so far over the last 10 months this year, is exports that go from, so stuff that is being shipped from the U.S. to China has plunged, right? And that matters because China is not a small player in the game. right? They are the second largest economy, and by a lot of expectations, within the next 10 years, they're going to become the largest economy in the world. If you're in a bad relationship with an economic leader, that has negative implications for the U.S. economy. And we've seen, again, change in exports. There are other areas that are taking advantage of this, but the U.S. is being hit fairly hard. So if you are a company that has, worked for over the last 20 years and you've seen trade open up, you've seen the economic trends and realize that, hey, China is a fast-growing market, you want to have some access to it, so you've put emphasis on exporting or having China as a big client. If you suddenly see all this happening, it's having a substantial negative impact. In particular, one area that's happened is agricultural sector. So if we were to look at soybean farmers, for instance, they put a lot of emphasis on shipping goods to China, who has a massive and growing demand for agricultural goods. And I've seen some estimates of it was about 90% of the soybean crop that was produced in the U.S. was shipped towards China. And what ended up happening this year and last year as a result of the trade war is that the shipments went to zero. And this has precipitated a need for the U.S. government to actually start bailing out soybean farmers who had massive amounts of their crops just go unbought for the year. So things went to rot, and it was just, and so it's been a situation right now where the U.S. has paid more in subsidies for farmers for agricultural subsidies to bail out as a result of the trade war than they've actually brought in from tariff revenue from the trade war. And emphasizing as well, again, that tariff revenue is coming from domestic companies, right? So it's not China paying it out. So one last thing to highlight in turning on the discussion of trade war is if we go to the next slide, from a market standpoint as well, the U.S. is not isolated, right? It is not dependent strictly on American companies are not dependent strictly on American clients and customers and businesses. So if we're looking at foreign sales of goods, what we've seen in 2018 is, the share that is normally received internationally has fallen. And if we look at the areas that are more reliant on, foreign revenue, and it's, again, that foreign share, it's not all China, but a growing chunk of it has been. If we look at it, it's tech and materials and energy and communications. So these are the major sectors of the U.S. economy, especially the fastest growing ones. And this has been a big reason why we've seen so revenue growth, which has become less reliant on globally, and there's been some negative implications and impacts there, and it's hitting some of the faster growing regions of the U.S. But if we go to the next slide, the impact here has been that it has caused earnings more or less to stagnate this year. Even though the underlying macro fundamentals have been okay, there has been a lot of pressure on earnings in the U.S. Now, the expectation is that, over the coming 12 months, is we should see a resumption in earnings growth, but it will be at a slower pace of growth than we've seen relative to other points of this economic expansion. And given that when you're buying a stock, you're buying access to those cash flows, and the growth, the overall return you ultimately are going to get in the stock market is dependent on the ability of the underlying companies to generate revenue and earnings. Slower growth on the earnings front most likely means slower growth on your performance as well, like smaller returns, which again isn't necessarily an unrealistic thing given that we've had this 20% run up this year. But the expectation is, we'll see earnings growth pick up, but you could be limited in terms of overall performance. But this is the important thing, though. Despite concern that we're heading towards a recession because you see more and more of that narrative, the fact that the overall macro backdrop is going to be okay, and there are risks to the outlook, is that earnings growth should continue. And inherently, if you have positive earnings growth, that should be positive for risk assets. So looking at stocks, looking at corporate bonds, looking at those areas of the marketplace. And again, so there are risks to the outlook, and the number one that I'm going to focus on in this time is the trade war, and that's something that is not going away anytime soon. So on December 15th, the U.S. is slated to raise tariffs on $160 billion worth of goods that are exported from China to the U.S. Whether or not they follow through with that is unknown at this point in time, and given how policy is done in the U.S., a lot of stuff is inherently unknowable until it actually materializes. what we're seeing is likelihood is that the trade war is going to continue, and it's going to carry on and cause movements in sort of sentiment and opinions on the outlook, and it's going to be causing clouds for the outlook, these uncertainties. But importantly, though, there are risks, but there are a lot of things that are positive for the macro backdrop. One is the consumers, and the second one is going to highlight on the next slide. So when we're talking about recessions and we're talking about ends of economic cycles and ends of bull markets, if you look back through history and if you look at the 11 recessions that we've had since World War II, virtually every single one of them has the thumbprints of central banks on it. So what you've seen is economies are growing, inflation starts to pick up, and central bankers try and cool everything down by raising interest rates. They want to make the cost of capital a little more expensive. But what they end up doing is raising rates too quickly and too high too quickly. It ends up choking off credit growth, and given that credit is a very important sort of fuel for an economic machine, that's when you start to see everything roll over. And if you look at previous cycles right now, so the chart on the left is central bank policy rates. So that's when you hear the Bank of Canada is making an interest rate decision, or the U.S. Federal Reserve, this is the interest rate that they're changing. We're in a situation right now where there is basically zero likelihood over the next year that there's going to be a central bank-induced recession. So not only are interest rates relatively low compared to previous cycles, and I've just highlighted the last two of them. So if we look at 2006, 2007, when interest rates are closer to 5%, and then you go back into the 99, 2000 when they're closer to 6%, we didn't even get to the halfway point of those. And what we started to see is this big adjustment now is that given there's concerns over the outlook and given that inflation has been fairly benign, interest rates are coming down. So the U.S. Federal Reserve has cut interest rates 3 times. The Bank of Canada has yet to cut interest rates, but there's a non-zero probability that they could over the incoming months. But the bottom line there is that interest rates are staying low from a policy perspective. Now, the other thing to emphasize too is that given the severity of the last recession and the financial crisis, central bankers didn't just cut interest rates to try and stimulate growth. They also went and bought about $12 trillion worth of bonds. So this is looking at the chart on the right. It's the balance sheet side. So it's asset holdings of the Bank of England, European Central Bank, Bank of Japan, and the U.S. Federal Reserve. So what happens when they went into the market and bought $12 trillion worth of bonds is that they now end up holding about just under a quarter of the global bond market. And when they're holding this, when they're going and buying these bonds, it's putting downward pressure on longer-term interest rates. So ordinarily, central banks can only control short-term. So the central bank policy rates are generally overnight rates, so very, very short-term rates. But it sets the benchmark for the overall market as a whole. What they did this last go-round with the financial crisis is they bought longer-term interest rates as well. So longer-term interest rates, so you're looking at the U.S. Treasury bonds, like the 10-year Treasury note is currently at 1.82%. That is artificially suppressed because of the central bank holdings. So what this means is, you have interest rates in general are low. And given that the central bank there's not going to be any aggressive hiking of interest rates, of short-term interest rates, and central banks are not going to start selling these bonds into the market, which would put upward pressure on longer-term rates. We go to the next slide. Interest rates are low. So the expectation, again, inflation is very, very, very muted. So chart on the left is inflation as it currently stands. Chart on the right is market expectations for inflation. So typically, central bankers react to inflation. They're concerned about the value of their currencies. So when they see inflation rising, that means $1 is able to buy less goods in the marketplace. But right now, we're not seeing inflation running aggressively hot. And if anything, inflation has actually come down from year-ago levels. And if you're looking on a forward basis, there's no expectation that you're going to see inflation start to pick up. And again, this is looking at a broad swath of the G7 economies. There's no expectation here that inflation is going to become unhinged that will cause central bankers to move aggressively. So basically, it's lower for longer. And if we go to the next slide, the very light line at the bottom is the Treasury. So those are looking at government bonds. So not only are government bond yields going to be low and maintain low, and you could see some modest move higher, but we're not going to approach previous levels, right? We're not going to see probably 5% on a U.S. 10-year. But this also carries over into other areas of the market. So investment grade, those are high-quality corporations that have investment grade credit ratings. And then high yield, so those are the lower credit quality, lower credit rated companies that have issued debt in the marketplace. But what we're seeing is that interest rates are going to remain low, and it's across the entire spectrum, right? So low interest rates are positive for economic growth. And the fact that we don't expect that, interest rates to rise aggressively in any way, shape, or form, that means that you're not going to have, again, the central bank interest rate-induced collapse of the market. So in other words, though, things should continue to go as they are. But as an investor, this is not an ideal chart if you're a bond investor, because ultimately the yield is what drives your return. And when yields fall, you have an increase in you get capital gains. But if you're a bond buyer and you're collecting a yield of less than 2%, that's not exactly a good return. And if you're holding those bonds to maturity, so if you're thinking that you're going to fund your retirement on these low coupons, this is something that's concerning in terms of how you're managing the outlook. Like if we go to the next slide, it's not just that interest rates are low; it's that they're unprecedented lows. So this looks at just the equity market. If you were to go and buy an equity market ETF, the dividend yield that you would get from that relative to a 10-year government bond yield, which is generally used as the benchmark interest rate. It is very, very uncommon historically for equities to have higher yields. And again, this is just a broad market index rather than any sort of dividend tilt or income-focused funds or anything like that. It is very historically a rarity that you would have dividend yields exceed government bond yields. And if you did, it would only be for a short period of time and then quickly would reverse. But what we're seeing is that globally, it's kind of hard to see there, but even for the U.S., it is a situation where equity markets offer an income premium over bond markets, right? So if you are an investor who is focused on income, and traditionally you've been able to rely on government bonds, you don't really have that same degree of opportunity. It's just a lower yield market. And this is something that needs to be taken into consideration. And one of the reasons why, from our perspective, we're allowed to take a tactical tilt in terms of how we manage the funds, which ultimately are tactical balanced funds, why we continue to tilt overweight towards equities. It's because there's more income opportunities that we view than are available in the bond market. And considering that we have this income focus, it matters. The other thing to think about is this next slide, and again, emphasizing sort of where interest rates are now. This is a relative valuation metric. So it looks at, a gauge of equity market valuation called the earning yield, and looking at just the bond universe index yield. So it's, looking at something that encompasses corporate bonds as well as government bonds. And historically, there was a tight range where this sort of valuation measure would kick in, right? So we're looking at data from 1980 to 2007. The average is that dashed line, and plus and minus one standard deviation. So, what's considered what happens about 68% or 70% of the time, what normally happens, are those black bars. And it's a fairly narrow gap. And what would happen is that when stocks became expensive, you'd see sort of a snap back towards that mean. But what we've had in the aftermath of this financial crisis, with rates being front-end policy rates being slashed and government bond buying putting a lot of downward pressure on bonds, is that strictly from a valuation perspective, everybody talks about the equity market being overvalued or being expensive. But in the context of interest rates, because nothing in financial markets can be observed in isolation, interest rates or equity markets actually look relatively cheap. So when we're doing our asset allocation, again, this is a consideration we put in perspective that, how are we going to tilt portfolios? Well, honestly, right now, bonds look expensive and they don't offer the yield that they used to. So when things look expensive, they become higher risk, because if you're going to have any sort of normalization, it means that valuations have to drop. And valuations drop, that means price drop. And considering that when people buy bonds, one of the components they're looking for, they want safe income-generating asset. If it's not as safe and not as income generating, you're going to sort of reduce your exposure. If we go to the next slide, even though equities have rallied 20%, given where earnings are and given sort of the macro outlook, they're still not historically expensive. They're on the expensive side of average, absolutely, but on a relative basis of bonds, they look cheap. But even relative to their own history, they don't look excessively expensive. So this is how we're measuring. So this is the S&P forward price earnings ratio. So it's a gauge of equity market valuations relative, based on their earnings. And the dashed line is historical average since 1987. So we're looking at 30 years worth of data with plus or minus 1 standard deviation. And there are times when things get expensive. So we saw at the beginning of 2018 that we were pushing against that 1 standard deviation bar, and then we had a fairly sharp equity market correction. But right now, from our perspective, given that the macro outlook isn't terrible, there are risks to the outlook, and growth is going to continue, things look okay. And just go to the next chart. This is something that we need to say, emphasize, and something we always emphasize with our clients and investors, is that even though there's volatility in the marketplace, and that can be frightening, and that realistically, volatility is going to continue throughout the next year, because we have everything that's going on with the U.S. administration, the concerns about the trade policy and the upcoming election, there's going to be uncertainty. But there's a reason to maintain exposure, right, in the market. So this is, we put this emphasis on time in, not timing the market. When we are doing our funds, we are not trying to sort of, high frequency trading. We're not trying to capture these market swings. We're taking advantage of longer term trends. Because timing the market is extremely difficult. And not only is it difficult to get out of the market, it's difficult to get back, timing when to get back in. And the example I like to use is literally, about a year ago at this point in time, in the marketplace, we had this sharp equity market correction. In particular, on December 23rd and December 24th, global equity markets fell between 5 and 7% in that 2-day span. Now, if you happen to be removed from the marketplace in those days, you're quite happy. You missed that sharp downswing. But chances are you're also removed from the market on December 26th, right? And on December 26th, in that one day, global equity markets rallied about 7%, right? So this chart is just looking at what happens if you are exposed to the market, looking at 8,000 trading days from January 4th to 1988 to the end of December of last year, and saying that by maintaining this exposure, by not sort of moving to cash, I guess is the best way of putting it, even amid volatility, if you happen to be in the market for all days, you reduce your opportunities of missing those best days. And those are the days you want to have exposure. Because again, it's just looking at, so if you happen to just miss 10 of the best days over the last 30 years, your annualized performance is 2 percentage points lower. And to put it in some context, that means that if you had invested and just bought and held over that 30-year span, versus if you happen to just miss those 10 best days, your annualized performance or the value of your portfolio would be only 40% of what it otherwise would, right? So it's about taking risk in the marketplace. You need to have that exposure, but you can be smart about it. So I think the last slide that I'm going to discuss with you guys, or the last 2 slides is the next one, is emphasizing, and Swag Guardian, how we manage our money and what we do, how we tilt our exposures, is this idea between, high quality and high dividend strategies. So these are kind of boring strategies that don't necessarily keep pace when we have these aggressive upswings in the market. But what matters is that they protect amid volatility, right? So this is looking at relative performance versus the benchmark, like the overall index. So this is looking at relative to the MSCI World Index. The quality strategies and the high dividend strategies outperform when you have periods of high volatility. And what that means is you're protecting on the downside, right? So I talked about fixed income assets. Traditionally, they want to be safe and income generating. What we're doing now is we're looking in terms of risk trade-offs. The safe and the income generating are more sort of in these areas of the marketplace. So while we expect more volatility to continue to play out, how do we want to have those exposures? We don't necessarily want to be tied to the high beta, so the stocks that move aggressively with the marketplace. We want to have those ones that are able to sort of temper those downside moves. Because if we go to the next slide, this is the area that we tend to focus on. It doesn't get a high acclaim, but if you look at even just over this last cycle, high dividend and quality names have performed very, very well. But more importantly is that if you stretch that out over many cycles, right? So again, we take a long-term focus in terms of how we're managing money, because we're not trying to, not trying to time individual economic risk events. It's just sort of managing these risks over a longer period. And we can see over the 30 years from 89 to 2019, there's a massive amount of outperformance of these quality strategies, which is, again, so in terms of how we're managing our funds, and we have some other slides on that, which hopefully we can share with you guys otherwise, and I'll deal with questions related to those if you will. But we are overweight equities in terms of our balanced fund mix. but we're not exactly taking on more risk. We're managing the risk and having more exposure to these quality strategies. And with that, so I just want to emphasize, markets can be a roller coaster. And it can be scary when you're on this those sharp trends, sharp drops and sharp turns. But ultimately, as with roller coasters and financial markets in the same way, the only people who tend to get hurt on these rides are the people who try and get off in the middle. And with that, I'm going to see if there's any questions.
Thank you, Dave. Thank you, Dave. Like I mentioned earlier, we'll have to answer some of your questions. First question we have. How does the consumer retail spending correlate with growing consumer debt?
How does consumer spending correlate with the growth of consumer debt? There is some causal linkage there, obviously, right? And then we've seen this in pretty much every developed and emerging market economy, is that debt loads have been increasing. And that is obviously a risk and a longer-term risk that we need to see, and especially something that's evident in Canada. But the big issue there, they go hand in hand, but when you get more income growth, that's a positive for that. One of the big things to focus on, and this is how it plays out, is that the consumer debt, and especially if we're talking Canada, but if we're talking more broadly, like in Europe as well, that isn't a near-term risk. Because the big concern with consumer debt and household leverage isn't so much the amount; it's the ability to carry it and actually service it and pay it off. Because people who have a lot of debt but don't actually have to have a large number of payments, they're not facing financial stresses, right? And what we're seeing on a financing perspective is, with interest rates going lower and reversing lower, is that mortgage rates have come down. Right? And suddenly people are refinancing and able to do, carry the debt that they have or even expand it, and it's not necessarily causing a huge problem. But yes, there definitely is that correlation, and that is, recessions are not inevitable. It will happen at some point, and there will be pain that will be felt. But right now, with policymakers doing what they've been doing, they're kicking that can down the road, right? So there'll be, a day where people have to get a little bit more control over their financing situation and manage their debts, and that's governments as well as households. But that's not something that's necessarily on the horizon, especially for the next 12 to 18 months.
Thank you. And last question: how do you see the U.S. elections impacting the markets in 2020?
How do I see the U.S. election impacting markets?
Yes.
So the U.S. election gets a lot of press and a lot of attention from everybody because, again, the U.S. is the single biggest economy. It's the most important financial markets in the world. And we saw, and we've seen over the last year in particular, the negatives that can come from having a politician who creates uncertainty in the marketplace. And realistically, if we look at the Democratic field, they're going to create some uncertainty. So ultimately, if you have a Democratic candidate winning, or at least showing signs that they're gaining in the polls, there's going to be a knee-jerk reaction that there's going to be uncertainty. It's going to be a break from the status quo, and don't necessarily know how it's going to play out. And I'm not going to comment on the politics one way or the other than, there will be uncertainty in there. And even if you have movements in this impeachment trial or, even Trump winning the election next year, it can cause some uncertainty in the marketplace, especially leading up to the election. The important thing, though, to note, and I can send some charts around on this because I've been looking into it, is ultimately, whatever, Democrat or Republican who holds office doesn't really have an impact on markets. Right? There'll be some knee-jerk movements initially, but if you look at longer terms, it ultimately doesn't have any impact. And if you think about it too, even though we've seen a lot more market volatility being driven by the office of the president, traditionally, politicians can't do that much that would impact markets. Right? They can impact tax rates, which, you'll get some adjustment and maybe things will grow slower, returns will be somewhat lower, but historically they've still been positive. And if you take it down a degree a little bit more too, even looking at Congress, so the makeup of Congress, and these are the people who actually make legislation and drive the sort of the political agenda. If you have a transition between, you know, a Republican-dominated House and Senate, or Democrats, or split, or a flip between the two, you know, if you look at a chart historically, there's basically an inconceivable sort of trend, right? There's no difference between who's in office between overall market performance. It's other factors that are driving that. So you're probably going to see some volatility related to the election, and that goes not just from the presidency, but also to the House and the Senate as well. Because if you see some shifts there, it's going to create, you know, a new direction possibly. But ultimately, when you take a step back and ultimately how markets react and how, you know, investors and economies go, you know, there's inertia in there and things mean revert. And ultimately, if the economy is okay, which again it is, you know, you're going to see continued performance. And again, so ultimately you're going to see some volatility, but in the longer term, things should ultimately be okay, I guess is the best way of putting it.
Thank you, David.
All right. Thank you, David.
So this concludes the presentation. To all have listened to the webinar, thank you for your participation, and come back in January.
Thank
you. Have a great day.
Have a great day, everybody.